Welcome back to the channel, everyone. Today I want to talk about this brilliant write-up by Wired. Obviously we know that the shorts never covered, but what this write-up does is shows how the SEC actually exposed that short interest is being manipulated. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, all of the information here is directly from the SEC Gov report. GameStop obviously had a high short interest for most of 2020 and 2021. GameStop was also oversold short by 130% at its peak. And in January 2021, GameStop short interest disappeared with very little to no reasonable covering to correlate with the percentage change. Now obviously this is the graph taken directly from the SEC report showing a high short interest in 2020 and 2021 before dropping off massively. In the highest price run-ups there was very little short covering as seen in red. In the highest price run-ups there was very significantly less retail buying because obviously the buy button was removed. The buy orders that were allowed were forced to the lit markets. And this is also another screenshot taken directly from the GameStop SEC report. You can see here in red the short seller buy volume, and there's very little buying going on at the back end of January and in February. So if the legal short interest decreased from 130% of the entire float down to say 20 or 30%, you'd expect to see massive buying volume coming from those shorts. But these red bars don't really give the indication of massive buying volume. So obviously my question is, how did that short interest, the legal reported short interest, fall from over 130% down to practically nothing if there was no shorts actually buying and covering their shares? And the SEC report also says a gamma squeeze did not occur. It rarely happens and derivatives trade gamma and delta neutral as much as possible. It also says that market makers were buying calls and not selling calls, but also weren't really covering their positions. They obviously touched on naked shorts, but never really explained whether it was actually going on or not, but effectively I guess from the report you can assume that it's not going on. The SEC report also touched on ETFs and how those ETFs can be used to indirectly short AMC and GameStop, but it also says with volatility in the underlying stock, ETFs did not experience or contribute to the price movement. And it also says that both the NSCC and the over-the-counter corporation experienced record volumes cleared on January 27th, but yet somehow very little of this volume cleared was shorts buying back the shares. Wired also touches on and says that after late January, the margin requirements normalised. Margin requirements shouldn't really have caused the removal of the buy button, so why did they remove the buy button? Brokers obviously deny any malpractice on the decision to remove the buy button, and they state it was to do with the increased margin requirements imposed by clearing broker margin requirements. But at the same time, as it just said here, the margin requirements shouldn't really have caused the removal of the buy button because they normalised soon after. And therefore the brokers removed the buy button voluntarily and they weren't pressured by the NSCC or the DTCC, but obviously it doesn't really mention too much about Citadel specifically pressurising them, which we know that they did. Wired also points out why GameStop ran up massively. The proportion of off-exchange activity initially rose as individual investor activity increased, and then fell off as volatility increased. And therefore, there wasn't as many trades going through the dark pool because of how much volatility there was. And therefore, the price skyrocketed when the orders went to the lit exchange, and that was supported in the GameStop report, the SEC report, supported by the shown percentages. And that's what these two charts show. When GameStop was trading on the TRF, the price was going up. But when the buy button was removed and they couldn't trade on the TRF or the New York Stock Exchange, obviously the price got crushed. You can see here that when there was a lot of volume in the alternative trading systems like the dark pools, the price didn't go up much. And again here, when it got crushed. But when there was a tiny amount of volume in those dark pools, the price went up. Something that's also interesting is how the SEC report talks about shares becoming hard to find and trade in January, which caused the wider spread in the NBBO. But despite the low liquidity, market makers continue to supply liquidity robustly, which isn't normal, and it talks about it down here, because obviously market makers can legally naked short illiquid securities. And therefore the SEC report is basically saying that there was naked shorting because liquidity stayed fine, even though the shares were super difficult to locate. I think overall this is a brilliant write-up by Wired, and if you haven't already, give it a read for yourself. I think the most important thing that stands out for me here is how this GameStop short interest fell from 130% and rocketed down with only a tiny amount of covering from those short sellers. Now currently most people don't have a lot of confidence in the stock market. These big market makers and institutions have all of these exemptions, there's a massive lack of reporting, and it basically seems like all of the normal laws and regulations that apply to regular people like you and I just don't apply to them. But when investing in cryptocurrency like Bitcoin, Ethereum and many others, it's much more of an even playing field. So I personally use BlockFi to invest in cryptocurrency. Not only can you just invest in cryptocurrency and buy some Bitcoin, but you can also earn interest on your deposits of up to 8.25% per year. BlockFi also offer a rewards credit card, where you can earn an introductory rate of 3.5% cashback on your purchases paid in crypto. There's also no annual fees, but unfortunately the credit card is only available in the US at the moment and not in the UK as well. And when you've generated a large profit on your investment, instead of having to sell off your Bitcoin and potentially missing the next run up, you can take out a crypto-backed loan with BlockFi. Instead of having to paper hand and sell your Bitcoin to buy a new car or pay down some debt, you can just take out a loan with interest rates from as low as 4.5%. So be sure to sign up to BlockFi using my link down below in the description to get up to $250 of free Bitcoin when you make your first deposit of over $100. And now I also found this extract confirming Ken Griffin's lies. It comes from an article written about the divorce between Ken Griffin and his ex-wife, and how his ex-wife was seeking to nullify the couple's prenup and claims Ken Griffin is failing to pay adequate child support. A spokeswoman for Ken Griffin's ex-wife said Ken Griffin, one of the wealthiest men in the world, continues to lie with impunity and to brutally and shamelessly attack the mother of his children in an effort to avoid his financial responsibilities to his family, and is saddened that he is using his enormous resources in an attempt to destroy her when it would be so easy for him to support his children as he always did during the marriage. And therefore, as we all know, clearly Ken Griffin does indeed lie. Now I also wanted to do a bit more research and a bit more of a deep dive into the AMC tokenized security that's now showing on Coinbase but is showing as not tradable. This post from Reddit thinks that this is super bullish because obviously tons and tons of people that do trade crypto and have Coinbase will soon be able to buy an AMC Entertainment tokenized security. So I wondered how that actually affects the AMC stock itself. Is this going to be a good thing because it means that loads of crypto investors are going to start buying AMC and potentially bring tons and tons more volume back to AMC, causing the squeeze because they can buy AMC on platforms like Coinbase or maybe even BlockFi or Binance or many others. But then I was also wondering whether this is bad. Is there some way that market makers can abuse this and use it to naked short AMC even more? So FTX actually made this post not too long ago. From reading the disclaimers, it doesn't really sound that great, but it is kind of good a little bit lower down. We'll get to that bit. So it starts off by saying this document may become out of date at some point and fail to reflect updated policies. That doesn't really sound too great. And it also says FTX reserves the right to restrict usage of its tokenized stock trading as it sees fit. Also not really what we like to see. But it says, so what are tokenized stocks? Equities are stocks that trade on traditional regulated exchanges. How is that trading regulated? It's fully regulated in Germany by CM Equity. So what exactly is traded on FTX? These spot tokens are backed by shares of Tesla, for example, custodied by CM Equity. They can be redeemed with CM Equity for the underlying shares if desired. In the future, there may be other ways to withdraw the token from FTX. So I guess in a way it's similar to the Brazilian BERs. Basically, real shares of AMC have to be held by CM Equity because those stocks have to be custodied in order with the spot tokens that have been purchased, or in line with the spot tokens that have been purchased. So it does seem like this could be a good thing, especially if the tokens are backed by actual shares of AMC. It means that it's going to open up AMC to tons and tons of new people that may have not invested in AMC beforehand. Typically those people that only invest in cryptocurrency, using platforms like Coinbase. They obviously wouldn't have come across AMC and wouldn't have purchased AMC stock, but now they have that opportunity. I also wanted to talk about James Bond's No Time to Die becoming 2021's #2 Hollywood movie worldwide as it nears $500 million globally. No Time to Die crossed $368 million at the international box office and $474 million worldwide, with today's business included. And therefore, the only film that's doing better than No Time to Die so far this year is Fast 9, and it will hit 500 million this weekend. And incredibly, for us UK apes like myself, the UK leads all play, and in the market the film has now become Universal's biggest movie of all time. Not just post-pandemic, but Universal's biggest movie of all time. That beats Mamma Mia, which held the record for over 13 years, and therefore, this is now the UK's biggest movie, pre-pandemic included. And I also wanted to touch on some wider market updates, and I wanted to start with this one from the Federal Reserve. The Federal Reserve, following a comprehensive review, announces broad set of new rules that will prohibit the purchase of individual securities, restrict active trading, and increase timeliness of reporting and public disclosure by Fed policymakers and senior staff. These tough new rules raise the bar high in order to assure the public we serve that all of our senior officials maintain a single-minded focus on the public mission of the Federal Reserve. And that comes from the Federal Reserve Chair, Jerome Powell, who interestingly has just been in the news for selling a massive amount of stocks back in October before the market crashed. I think this is really good news because it basically means that policymakers and other people that get insider information about companies and the economy can't make trading decisions based off that. Or they can't make economic decisions based off their investing accounts. They have to do what's actually right for the economy and what's actually right for those companies. For example, if a company has committed a crime, they can't just dismiss that crime because it would mean that their investing accounts go down. They actually have to take it seriously and be non-invested in those companies in order to make fair judgments. Now, I've seen a lot of articles recently of China saying the contagion from Evergrande is contained and that there's going to be no contagion and everything's fine. China have been saying their financial system will not be impacted because Evergrande is contained and it's a one-off event. They've also been saying that it won't spill over into the US and the UK and European markets because again, it's contained in China and it's contained to Evergrande. Well, Sophia was going through some old stories and found this gem from March 14th, 2007. The Lehman Brothers called subprime mortgage risks well contained. I wonder how that worked out for Lehman. Oh yeah, they went bankrupt, didn't they? On March 14th, 2007, Lehman Brothers Holdings, the second biggest US underwriter of mortgage-backed bonds, said risks posed by rising home loan delinquencies are well contained and will have little effect on the firm's earnings. So they didn't even say it's going to have little effect on the economy, they even said it's going to have little effect on just Lehman's earnings. Making loans to borrowers with poor credit histories, packaging them into bonds and trading those securities accounted for 3% of revenue in the past 6 quarters, and the firm is hedged against declines in the market. So we now know that trading in subprime mortgages didn't just account for 3% of their revenues, and they also weren't suitably hedged either. Their exposure was much bigger than that, but they weren't letting on back in 2007. And that's exactly what China's doing at the moment, not letting on just how exposed China is and the rest of the world to Chinese property developers like Evergrande. And finally, before you leave me today, I wanted to end with something funny. Coke rat Cramer, his predictions are correct as much as the hair on his head. How it started. Cramer said he sold almost all of his Bitcoin after China's crypto crackdown, where Bitcoin fell to $32,000 per coin. And how it's going now, Bitcoin obviously just hit a new record high, blowing through $65,000 all the way to $67,000, and Cramer is not looking too happy. Maybe if Jim Cramer did the exact opposite of what he suggests to do and buying when he says to sell and selling when he says to buy, maybe he would have made some more money. It really does surprise me how Jim Cramer ran a hedge fund for so many years when he can be this wrong with investing advice. Guys, be sure to let me know down in the comments below what you think about the SEC exposing that the short interest was manipulated and how the shorts never covered in GameStop. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!